Good morning, good afternoon, good evening, wherever you are. However you're listening, thank you again for joining me for another video. As always, a free way you can support this channel is by hitting the like button, subscribing to the channel, leaving a comment for the algorithm. I appreciate those of you who shared with me what you ate for lunch or breakfast yesterday. Keep up the good work. All right, let's go ahead and dive on into this. I don't know if you noticed, so I woke up pretty early this morning, and just what's the first thing I do every morning? I check the price of Gamestop and Bitcoin. But Gamestop, I noticed, it seemed like things were going to be pretty flat today, and I was just like, all right, what am I going to talk about in the video? And then an article came out at 6:45 a.m. Eastern Time announcing that GameStop appointed a new chief growth officer. And I thought, wow, okay, here's some news. So if you've been watching this video, if you've been watching this channel, you know why this matters, okay? It's not just some little bit of news that is thrown out there and that's going to have no effect. So think back again to certain things that acted as catalysts pushing the price up. When GameStop was at $40 a share, after all the craziness in January, went down to $40 a share, it was $40 a share, and GameStop announced that they were parting ways, that their chief financial officer was resigning, quote, resigning, when in reality he got fired. It was to clear the way for a new vision, new growth. And what happened after that? Later that day, the price of GameStop spiked, and I think it was that day that GameStop went up to something like $200 a share after hours before settling back down. And so that one thing right there acted as a catalyst. And then recently, I think it was last week, they announced that they were parting ways with their chief customer officer. And again, that didn't cause quite nearly the same level of increase in the stock price, but it did help. It helped the stock price increase. And so pre-market right now, what we're seeing with GameStop, this little bit of a boost before hours is because of this. It's because GameStop has appointed a chief growth officer. But not only that, oh man, if there was any doubt that Ryan Cohen is going to steer the ship for the future of GameStop, then those doubts should be completely erased now, because additionally, the company made two other executive hires. Andrea Wolf, Vice President of Brand Development. Miss Wolf, who previously served as Chewy's Vice President of Marketing, started March 29th, 2021. She has held executive and director level marketing roles at companies such as Outdoorsy, Retail, and Whole Foods. In her new role, Miss Wolf will help drive branding, content, social media strategy, and other digital initiatives. I mean, come on now. That sounds pretty fantastic to me. In Ryan Cohen we trust, and if he's bringing people over from Chewy, fantastic. And then second, Tom Peterson, Vice President of Merchandising. Mr. Peterson, who previously served as Chewy's Vice President of Merchandising, started March 29th, 2021. He also held senior marketing and merchandising roles, especially retailers, such as Artenza and Coro. In his new role, Mr. Peterson will help drive vendor relations, product management, and related merchandising initiatives. This all sounds great to me. I'm excited about the future of GameStop. It's why I will always, even after all this craziness ends, I will always own shares in GameStop. I will be looking to buy dips and looking to increase my position. Now, as far as their chief growth officer is concerned, Mr. Wilkie, Elliot Wilkie, to the role of chief growth officer. He's an Amazon executive, and it's funny because I remember his name started with Jeff. I kind of had a dream list of people who I wanted to fill the CFO role. And it's essentially Jeff Bezos' number 2 guy, also named Jeff, who was kind of like my Rush crush. What do I mean by that? I mean, I was in a fraternity in college, and so we had guys that we would have go through Rush, and kind of the guy that we wanted to fill a certain role. And so this number 2 guy at Amazon resigned, and I was hoping that he would become the new CFO at GameStop, which seems like it would be a step down. But if GameStop, it's about excitement for me. If I was an executive and I was entering a new position, I would want to see hope. I'd want to see development for the future. And so anyway, Elliot Wilkie, an Amazon executive. He joins from Amazon, where he spent the past 7 years holding a variety of senior roles across segments such as Amazon Fresh, Prime Pantry, and worldwide private brands. He began his career at P&G, spent more than a decade. Seems like a good hire. I don't know much about him. I will do more research about him just to try to get a better feel. But it seems, in my opinion, like not only the 2 Chewy executives, but Elliot Wilkie, that what's that communicating to me? That Ryan Cohen has a vision, and he may not be the CEO, but he's in the CEO's ears. So let's do this, Some other things that I want to talk about. So here's a picture of what things are going to look like when the mother of all short squeezes happens. If you have been questioning whether or not what kind of an effect that this is going to have on the market as a whole, it's going to have an amazing effect. It's going to cause the market, things within the market to crash. And so I talked about this yesterday. A hedge fund that people on Wall Street bets were seeing, there was a bit of confirmation bias going around. All right, hey, this hedge fund, Archegos, failed, and so maybe that has something to do with GameStop. It turns out, in my opinion at least, that it had nothing to do with GameStop. It was just they were being irresponsible pricks, and so they failed. They were forced to dump shares last week. They're in a whole mess of financial trouble, and so what happened? Well, hedge fund Archegos, their failure, slams Credit Suisse and Nomura and other banks. And so these are major players. We're not talking about some mom and pop shop in Brownsville, Kentucky. I don't even know if there's a Brownsville, Kentucky, but Nomura and Credit Suisse are 2 major players who, all right, look at this. The Nomura and Credit Suisse said Monday that earnings might take, quote, significant hits after a client of their broking services defaulted on margin calls last week, roiling Wall Street. Shares in both banks plunged on Monday, wiping out billions of dollars off their market capitalization. This is what we're talking about is going to happen when these hedge funds collapse, is that's going to cause a sell-off on the stocks that they hold, not just, except for GameStop. They're shorting GameStop, so they don't actually hold shares of that. But anything else that they're holding, that they're in on, those things are going to drop. The clearinghouses are going to drop. And it's going to go up to the big banks. Those are all going to suffer as a result. And so just keep that in mind as we're moving forward. It's just, I have this feeling that it's getting hot. It's getting a little too hot in the kitchen. And so what's coming? Well, what's coming is if you own other stocks, those stocks are probably going to take a hit. And so keep that in mind. What's not going to take a hit, though, is Bitcoin. I said it again. Okay, moving on. Retail trading was set to be a risk to markets during the GameStop saga, but the Archegos blowup has Reddit users pointing fingers back to Wall Street. This was a really interesting article. I just thought it was helpful. It is a Business Insider article, which my rule with Business Insider is... I'm sorry, I'm just now seeing Dow, S&P, and NASDAQ futures are down. Remember what I talked about with negative beta yesterday? Remember that? So GameStop's negative beta is insane right now. And so GameStop's up, NASDAQ, S&P are down, or Dow are down. That shouldn't be a surprise. But all right, My rule with Business Insider articles is pretty much to just read the bullet points. I did read this whole article, and I thought that there were some really interesting things here, so I might take some points from the article as well, but let's read these bullet points. The hedge fund Archegos triggered $20 billion of selling Friday after failing to meet margin calls. I wonder if I can exit that video. I don't want a copyright claim. The leveraged blowup has Reddit traders questioning who the real systemic risk is to markets. Wall Street bets and retail trading boom were said to be dangers to the markets in the GameStop saga. That summarizes the article pretty well. It's just like, where is it? There were parts of this article. It was really frustrating to read this because it's like this. European Union regulators said that the Redditors' actions, quote, could constitute market manipulation and that they would monitor the situation as well. What situation as well? After GameStop's price soared, U.S. regulators eyed whether the Reddit forum and its retail trading members were part of market manipulation. The SEC and CFTC began reviewing traders' actions on forums like Reddit to see whether illicit activity took place. It's like, come on, really? You're looking at us. We're a small fish in a big pond. I hate to say it like that. I mean, we do have power because we have our weaponized autism, which is not original to me. We have our weaponized autism, and that the combination of our stupidity moving in the same direction does have power to move the markets. But come on, hedge funds have more ability to manipulate the market than anyone else. And so it talks about this, the man who runs Archegos Capital. This was what was fascinating to me. Archegos Capital is run by Bill Huang, a former investor at the famous fund Tiger Management. And let's read a little bit about Bill Huang, if I can find that information here. It says something about Goldman Sachs. Goldman Sachs had Huang on its blacklist after he was charged. So he was charged with something. Many Redditors and market commentators questioned why the banks would allow Archegos to leverage its bets to such an extent given Huang's history. He pleaded guilty to wire fraud in 2012 after his firm Tiger Asia traded on non-public information, reaping $16 million of illicit profits in 2008 and 2009. Prime evidence of market manipulation to the point where Goldman Sachs had Huang on its blacklist. However, at some point in the past 2.5 years, the firm, quote, changed its mind about Huang. In other words, they saw green and they wanted money, as they always do. And so, anyway, that change of heart may have allowed Huang to leverage his bets on equities. And come on, it's so obvious who the bad guys are here. You're going to point your fingers at us? We're retarded. And you want to blame a bunch of retards for what's going on in the stock market? When, how old is Wall Street Bets in comparison to these hedge funds, to all the shadiness that happens on Wall Street? There's no comparison. So why are you blaming us? Oh my goodness. All right, let me cool off for a second, and then we'll move on. A couple Reddit posts that I thought were interesting. Check it out. I need to upvote this. Found a few things in the newly filed SR-NSCC-2021-004 that came out today. A few things that got my attention. Implied volatility, IV, will no longer be incorporated into calculation of VAR. This is a good thing. What is IV? IV is basically looking back and suggesting this is how volatile we think a stock is going to be over the coming months. And IV is huge with options trading. That is what causes, and if you ever hear me talk about whether an option is too expensive or not, it's because of IV. And so GameStop's options are ridiculously expensive right now. And it's because of the implied volatility. It is a measure used. It's just mathematics that people who sell options need to have some kind of confidence that they're going to make money, and the higher risk that they're going to lose money, the more expensive those options should be. It makes sense. And so GameStop's stock has a very high implied volatility, which causes those options prices to be higher priced. So the fact that implied volatility will no longer be incorporated in calculation of value at risk, let me just say this. It just got harder for firms to lie about the overall risk of their positions. This is a good thing. Now, the second thing, I don't really see it as it's a thing. It's, maybe we'll see something from this, but the NSCC can pull funds from the clearing fund to help pay for a member's losses 2 business days after a loss allocation notice. So the general summary of this from this poster on Reddit was that the hedge funds will no longer be able to be bailed out to the extent that they have been getting bailed out before. So I think if these things were in place in January, when Melvin was basically about to die, then Melvin would have died. But, all right, what's the point? Let's circle back to VAR. Let me read his theory. The NSCC will now be able to verify a bear's risk better through a more accurate VAR calculation, which makes it harder for firms to fake their risk numbers. More accurate risk numbers will increase their deposit requirements into the clearing fund, which leaves them with less available capital. Large short positions with less capital means more general risk and liabilities, which further increases the deposit requirements. This compounding effect will lead to nonstop loss allocation notices, which eventually forces the member to either cover positions to help pay for loss allocations or pay for their loss allocation cap and stop receiving help altogether from the NSCC and DTCC. So here's the thing that is fascinating about this is you think back to 2008, you think back to the stock market crash, to the mortgage crisis in 2008. What caused that was a whole bunch of deregulation. And I am generally in favor of deregulation, but we need some regulation in certain circumstances so that people in businesses don't find loopholes and different ways to steal from the average American person. And so what I'm seeing right now with the DTCC, with the NSCC, is that they were in a position where they had a whole lot of deregulation. They were benefiting from a whole lot of deregulation, but now they're seeing the writing on the wall. They're seeing the pressure coming from the United States government, and so they're self-imposing these rules to protect themselves because now they have a vested interest in protecting themselves. And so good. Because all that shadiness that happened in January, it's not going to happen again. And we will see the moonshot coming much sooner as a result of these things. And the last thing I want to talk about here, all right, I just thought, I thought this title, I liked the title, and I liked what this person had to say, Rich Hodler. Either GME will be the catalyst for a market crash, or a market crash will be the catalyst for GME, and Wall Street knows this. That sentiment, I agree with the sentiment. I like the sentiment. And that's why I'm saying, what I'm talking about here with a hedge fund that collapsed, having an effect on Credit Suisse and Nomura, by no means small players. What would I guess will happen here? I think GME will be the catalyst for a market crash. And so what does that mean for anything else you hold? It's like, no, I'm not going to say to sell, especially if you have tech stocks. Those things have been taking a beating lately. It's like, just hold and ride the wave. I have stopped buying options because of this. That's how serious I am. I've stopped buying options. Once all this happens, and if and when the market crashes, those options are going to be quite attractive and they'll be very cheap, and I will be an eager buyer. But until this GameStop drama is over, I am done investing in other companies. From an option standpoint, I'm willing to buy shares and just kind of ride it out. But options, no. No. So let's read his theory here, and then I'll be done. My theory: the whales are keeping a lid on GME to buy time to prepare. If it blows now, people over-leveraged in unrelated areas go tits up, like Archegos, and FEDs come in, and people start playing blame games, blah, blah, blah. If it's 2008 and you knew Lehman was going bankrupt next month, wouldn't you buy time to cover your ass too? They're buying time to move their positions and for NSCC to file their new rules, not to mention Kenny G knows this and tried to put the blame on retail in his latest interview. Something is coming. Either GME will be the catalyst for a market crash, or a market crash will be the catalyst for GME. So actually, now that I read that point, I understand what he's saying. Maybe what's going to happen is that there's going to be a massive sell-off so that GameStop will reach the stratosphere, and that sell-off in preparation for GameStop, because they see the writing on the wall, will be what causes the stock to moon. So we'll see. I mean, remember the fundamentals. Look at my video yesterday where I talk about beta. Negative beta at negative 23 is out of this world. It's insane. It's insane. That is a sign of manipulation. That's a sign of, what am I thinking? That they're buying time, but that they're running out of bullets. It's so clear to me. So, yes, if you want to know, yes, I am going to load up a lot more on GameStop, on shares, very soon, probably today. So, otherwise, I hope you have a great day, great rest of your week, a prosperous week. Stay safe out there. Stay safe with your money. All that stuff. Love you guys. Peace.